Good evening, master traders and money magnets. SPY decided to give us a nice gap down after the false breakout setup from last Friday, where SPY failed to defend 646.5-ish breakout as support. False breakout setup led to a gap down, and then the question was, what kind of gap down is this? Is this a breakaway gap, an exhaustion gap? And I looked at the price action today. It was pretty nice in my opinion. In my opinion, this was tradable. The trap setups, the regular setups, it was all nice level to level style. But we look at that candle and it looked like the dip buyers came and bought the dip. If this was a breakaway gap, now breakaway gap is when we do not get traditional breakdowns of support and resistant levels, and instead we either gap up or gap down from them. This morning SPY was attempting a breakaway gap when it was gapping below my uptrend line here, and then you can see an example right here of what a breakaway gap should look like, where it gapped below the uptrend line and then there's more selling pressure. Because with this gap down, the idea is that it gets a lot of people interested, get a lot of people bearish to help push the market down when we're gapping below a critical level. But instead, when we look at the context of the price action, it looked like they bought the dip, which is why it looks more like an exhaustion gap to me. When we was at these higher prices flirting with all-time highs, the buys look like they just didn't have enough strength to keep on going. But they were blessed with a gap down, an exhaustion gap down. After being too exhausted of pushing price to uncharted territories, they were blessed with an exhaustion gap, and it looks like the dip buyers bought the dip. Another thing about breakaway gaps is that when it breaks below or gaps below a trend line, it usually does not recapture. It must be defended. Otherwise, it's no longer a breakaway gap, or it'll no longer be valid. So when we're looking at this, if this is to be a breakaway gap, because what happens next is very important, because it can still very much be a breakaway gap if this trend line does not get recaptured. And the next thing it needs to do is start breaking down those support levels, especially the low of today's candle around 634.9-ish. But if it does, and that would need SPY up back above 641, then we know for sure, for a fact, that it's not a breakaway gap, at least not a bearish one. And that should put 643, 645, and 646.5 back in play, and above 646.5 would definitely be bullish. But to be bearish, that 641 level must not get recaptured. Now I know it's going above that level in the aftermarket, but a lot can happen between now and the morning. So if we're below 641 and we want to get bearish, we need to break down support level 639.5, 638, have a level at 636 and a level at 634.5. Below 634.5, I would feel a lot more comfortable being bearish, and maybe, just maybe, this is actually a breakaway gap. But right now, that is not looking like the case. Like I said, you see an example here of a bearish breakaway gap is usually the start of a new trend. When I see people buying the dip, it does not look like the start of a bearish trend. Here's an example of a bullish breakaway gap. That's a bullish one. You can see it continues the trend upwards, and it starts off with buying pressure, or it draws in more buyers. This did not draw in more sellers. I'm still open to a bearish case scenario, of course, because Unco is a sheep style trader. We follow the price action, but I'm just gonna call it as I see it. This does not look like a breakaway gap, and if we clear 641 tomorrow, it's likely we could head up higher. 645 is around where this gap is. So not bearish unless we start getting down those support levels, especially 634.5 and 633-ish. Break it down, maybe a big old M pattern can play out. But right now, it can go either way. The best thing we need to know is the levels and the setups, and be ready to trade it unbiasedly tomorrow. Moving on to Triple Q. Now, Triple Q, for the first time in a while, retested the 50 daily moving average, and it did find some buying pressure. So once again, those dip buyers are taking advantage of higher prices. And I tell you this, if they clear 568, 569.7, and 571, this could definitely send Triple Q back up to 576, 578, and possibly even the 580 level. But to be bearish and to make this gap down more meaningful, I have support at 565.8, 564.5, and 563 fib level. Triple Q, the bears must break down those levels, and the 50 daily moving average right around 562.4 must break down for me to be bear bias. Here is NVDA. It actually closed below the 50 daily moving average. You have this big body red candle followed by a gap down, and it's looking like a doji. You need to watch the range of this doji, because if 172.5 clears tomorrow, that would be bullish. But 174, 175.5, 177, and possibly up to 180 or higher. But if we're below that level and we break back below 171 and 169, I would favor we go test the 167 level, which is around the low of the doji. If that level breaks down, I would definitely be bear bias and favor a bearish continuation to the downside, maybe another $5 to $10. Tesla, well, last Friday it treated the 20 daily moving average as a support. Today it treated that same moving average as a resistance. We have to be careful of a morning star pattern, because we got this big body red candle followed by a doji. If we gap up and recapture the 20 daily moving average, that would be bullish. We could expect a $10 to $15 move back to the upside. But if we take out the low of the doji, which is around 325.6, so we need to stay below the 20 daily moving average, and if we stop breaking down 325.6, I could expect another $10 to $15 move back to the downside for Tesla. Here is coin. It's been retesting that 20 daily moving average as a resistance, and that 20 daily moving average has been helping the bears out, but it's been knocking on the door, and the bears need to show some bears follow through and take out some more support levels. Staying below 304.5 will help, but it needs to get below 300 and take out the 295 and the fib level around 293.3. If it does, I would favor a lot more downside. But if we take out and recapture the 20 daily moving average, which is around the 311 area, I would definitely believe that coin can be bullish, and I'd favor another $20 to $30 move back to the upside. Here is IWM treating last Friday's buy zone as a sell zone today, but the level I'd like for you guys to watch are 234 and 235.5. If those levels recapture, I would favor IWM going back to new all-time highs. Keep in mind there was this pivot high from August 13th, and it served as a support level today. So I'll be watching that support level for tomorrow, because if we break it down, I would be bearish. That would need IWM to break down to 231.5 level, and I do have a fib level at 230. Those levels fail, I would be bearish on IWM and favor another $5 to $10 move back to the downside. And last but certainly not least, here is the VIX. We want to see the VIX going higher, even though that's a very nice wick, really long wick actually. We got to see what happens tomorrow, and we want to see it go up higher, because if it go up higher, it'll be volatile and tradable for us. So if VIX start breaking down 16 and 14.7, that might not be too good for the volatility. But if VIX is above 17.5 and it finally clears that 19ish level, we can expect some more beautiful moves, some more tradable moves. All right, so either way, let's keep our mindset strong and remember and believe that we are money magnets. We are master traders. Let's embody that and know the levels and setups, and let's trade it unbiasedly. Love y'all. Peace. You guys are still here? You know what? You don't have to go home, because it's not yet over. Check it out. Since you guys are still here, you must want more content from Uncle Chartist. So how about I do some option flow for you guys? We'll look at SPY. Yeah, let's filter it out. We'll look at the high premiums like 100K or above. We'll look at any expiration date. We'll look at the ask and above the ask prices. Oh yeah, this is looking good. Okay, done. And it's looking overall bearish, guys. Holy moly, donut shop. $52.2 million in premium compared to $10.7 million in premium. That's pretty lopsided, don't you guys think? Well, let's take a look. We'll take a look at the sweep orders. The sweep orders are the most aggressive. And I think with Cheddar Flow, I can just pick the sweep. There you go, pick the sweeps. Oh my goodness, $35.9 million inputs compared to 8.8. That's super lopsided, guys. So just something for us to pay attention to is the fact that there was a lot more big money players buying puts compared to calls. Yeah. Well, hope you guys found value in that.